Hey, good morning, good afternoon. Give me a moment. Okay. Good afternoon to Michigan people. Good morning to Bay Area. Who else? Who else we have from? I remember some folks used to join from, I guess, Iowa and New Jersey. I don't know if we still have a New Jersey folks. Good morning, Nyanka. Good morning. All right, guys. So what do we want to talk today? I got some stuff. What do you have in mind? Ah. So let me see. Okay, folks are still joining in. I see Henry, Brand. Uh, I don't recall seeing this name before. Brand, is this your first time today? Okay, it is. Okay, welcome, welcome. Glad to have you here. I see another name, Aditya Garg. Aditya, is this also for you? Is it the first time, or maybe I missed you in some prior meeting? First timer. Cool. I welcome you all. It's always good to have some new folks. We get a different perspective. Um, so, and yeah, feel free to unmute yourself and, respond if you want to. I just want to understand what attracts to you to this. What kind of a investment or philosophy do you have? What are you looking to get out of these 2 hours? Generally, it goes to 2 hour, 30 minutes. So you want to share, Aditya, Brand? I can't seem to be able to unmute. Hold on. It says allow participants to unmute themselves. Should be it. Okay, let me just do it with Aditya once again. Okay. Yeah, can you unmute yourself now?
Yes.
Can
Hi.
anyone?
Yes, I can unmute now.
Hold on. I am not able to hear you. Maybe let me see if my uh, speaker connection is on the. Okay, hold on. Yeah,
Can you hear us?
I have to change my microphone, and I think the speaker, it's a yeah. Okay, now I can hear you. Yeah, please go ahead.
Okay.
Thanks, Ray. Yeah, Aditya, what brings you
Go on,
here?
sorry.
What are you looking to get out of this?
Well, thank you for organizing this. So first of all, I was just getting started with options, and I was looking at just the different content that's around, and this was one of those things that came up. And yeah, I thought it would be a great starting point to get connected to people who have been practicing them for some time. And yeah, I've been doing stock investing for some time, just very new to options. That's it.
Cool. Okay. All right. So as you might have noticed in the event list, Saturdays mostly we talk about stocks generally.
Right.
If someone has specific questions around options or strategy, yeah, we can bring it up. But right now, I'm doing a kind of a boot camp sessions on options. I will talk about it. We are on a fifth drill. It's free to attend. The next one is it happens on Wednesday every week.
Yes.
So we are already on our fifth drill. So we covered some of the basics concepts already. So it's a long, I would say it's a 14-week boot camp. So yeah, if you're interested in getting into details of options, I think that would be the right place. I can talk about options here, but I'm not sure how many people actually going to go deep in option in this meeting. So it's like in this Saturday discussion, I keep it around general stocks, earnings, and yeah, if you have questions on options, yeah, happy to discuss that as well.
Sure. Thank you, Vivek.
Cool. All right. Okay, guys. So yeah, again, a couple of things which I wanted to cover today. One is around earnings. This is earnings season. I think this week was one of, I guess, two of those busiest weeks. I'm hoping next week it will probably subside a little bit. I didn't check what companies are coming out with earnings next week. Maybe I'll check it out later. And also last Sunday, the previous Sunday was Berkshire Hathaway's annual meeting. And if you're anyway, at any point of time, if you follow Berkshire Hathaway or Warren Buffett, this is like a big, huge sporting kind of an event. The shareholder meeting happens in a stadium. And I know this time, I think 40,000 people attended. You don't see these things or hear these things about a shareholder meeting, right? Shareholder meeting is like tend to be boring, but not with Berkshire Hathaway, right? This is like a rock concert, and that's why it is also called as Woodstock of capitalists. So I want to give you some quick updates or summary of that 7-hour long session. I
Vivek,
spent most of my Sunday going through the recording of Berkshire Hathaway's meeting. I think it happened last Saturday.
Vivek,
Yeah.
I went to a few shareholder meetings in '96. Intel was rocking, and I guess I only went to two or three, but then the other one was really calm. But if a company is earning money, it's going to be rocking,
Yeah.
Yeah, it's not like a sabbatical like Warren Buffett, but it's still, they're very upbeat when they're earning money. Oh, by the way, I think it was during the Andy Grove days that I
Oh,
went to
okay.
Intel.
Yeah, that time Intel was at its peak, right? So, and now it is becoming, I don't know. I mean, nowadays things are not looking good for Intel. The last week, again, Biden administration, they revoked the licenses of both Intel and Qualcomm to supply some of the chips to, I guess, Huawei. So Intel kind of lost its way, and its lunch got eaten away by NVIDIA's and AMD's, right? So anyway, so we're going to talk about that thing that did not show up in the poster that I made, which I put on Meetup, was today morning I realized that I didn't mention about the Howard Marks memo that recently came out. So I had not, so today morning was just about to go through it. Then I realized it would be much better to do it together in this meeting. So I do want to talk about that. If you guys know me, I'm a fan of Howard Marks, especially his risk management and how he look at risk, and his latest memo. Uh, Again, I've not read it fully. I started reading it, but then I said, okay, we should do it together in this meeting. So gonna talk about Howard Marks' memo. Yeah, so these are I would say, broad topics, but as always, we can switch if you have something else in mind or you want to talk about something else. Or if someone has a stock that they want to bring up for discussion or want to tell me what's your bullish thesis or, to the rest of the group, most welcome. You can present it. Okay. Alrighty. So let's dive into it. As always, nothing is financial, investment, or tax advice. Do your own due diligence or talk to professionals. Okay. Don't follow anyone that you see on Zoom or YouTube or on a meetup. That's a bad strategy for investing. Okay, so let's start with the first of all. How many of you actually know Jim Simmons? Heard of this person's name?
Yes.
Right. Okay, so he is kind of called as he died, I think, at age of 88. or 86. I don't recall the exact number. He died, I think, 2 or 3 days ago. And if there is only one person, I think, who has actually been able to beat the market consistently using quant strategies, is Jim Simmons, right? He is also called as the father of quant whole revolution in Wall Street, which is using quants to extract an alpha from the market, right? And I think while back I talked about him when I finished reading his book. So yeah, so a quick thoughts about Jim Simmons. He was finished his graduation MIT at 17, finished his PhD from UC Berkeley by 23rd. So he is like, he's already a prodigy, a math prodigy. Sachin says he was my university professor. Oh, okay. Yeah, and then he was teaching in university. He drove motor scooter from Boston to Bogota with some of his friends and almost got killed. If you read his book, there is a good narrative around what the heck they were doing there. Started a company in Colombia with a friend, and I think money from their dad. He was hired by IDA to break code, and he was the person to solve minimal varieties and Riemann manifolds. Don't even ask me what is this, okay? Don't even ask me. But he got fired from IDA because he spoke against a Vietnam War. Then he was teaching math in Stony Brook. There's an interesting story about how he built the whole math department in Stony Brooks, developed a theory in physics, which contributed to more to physics than any other physicist would have done. Got bored with math and started modeling financial markets. And he used his concepts that he had developed in this thesis to figure out how the markets may move. And they left teaching and starting a hedge fund at age of 40. And all his like friends and in academia were not happy with him, because why would you leave such a noble profession of being a professor and start like become a trader, right? Traders were not looked upon very generously in those years. But he studied Renaissance technology, and his fund, the main fund of Renaissance, was Medallion. If you would have invested in Medallion 1988, it would have grown to almost 400 million by 2018. Just think about it. That's a compounding at 64% CAGR over this whole long period. And it never had a negative return. And even if this is like a pre-fee and pre-tax, even post-fee and post-tax, it was still 40%. So I don't think there is anyone, not even Warren Buffett, who could actually match his record. And then he started donated a lot of money to different institutions, and he was a chain smoker. And he got to live till 88. I don't know, like Warren Buffett, it's all Coke and See's candies, peanut brittle, and still 93. Jim Simmons, chain smoker, 88. Okay, don't go and start smoking or start eating a lot of candies just because, hey, these people were able to live so long. But this is the book. If you really want to know more about Jim Simmons, the man who solved the markets. Very, very interesting book. And I think folks don't, because it's a very well kept secret of what they were using to run the Medallion Fund. And I think in 1990 or somewhere in 2000, he stopped accepting outside money. So only employees of Renaissance Technology were allowed to invest with him in Medallion Fund. It was like his own money started. And yeah, the Medallion Fund is closed. Renaissance has other funds, but they are not doing nowhere close to what the original Medallion Fund had done. And folks don't know what strategies that they were using that that he was able to get consistently, like, no down year for 30 years. That's a record, I think, that is unmatched. At least I don't know of anyone else. I've looked at all the Warren Buffett every year records. He had his own, good and bad times. He's a great investor. But yeah, I think this is what sparked the whole interest around quant strategies and how to do financial modeling to get these returns. Unfortunately, I don't think anyone else have been able to do anywhere close to it. So Jim, he was in completely different category, but he's no more now. So quick tribute to him. The biggest donor to the university till date. Yeah, I heard that he was big on philanthropy as well. Berkshire Hathaway's official homepage may be managed by Warren Buffett. Yeah, exactly. If you look at it, it's like 1980s, right? Right. It's such a plain one single homepage, straight out of a 1980s web page. So that's on them, Simon. Let's talk about and get some give you some updates on the Woodstock of capitalists. This year, I think this is the first time they actually streamed the movie about Charlie Munger. So looks like this movie has been, earlier they used to show, but they used to show only it in the stadium. There's a whole I think 30-minute long movie and the clips from Charlie and Warren Buffett, and I didn't even realize that. I mean, if you have not seen it, you should go and watch the initial that movie part, and it's so hilarious. And he was in Desperate, so it's like a Charlie and Warren having some cameo in Desperate Wives, in some movie scenes, even on a Breaking Bad with the real actors, and it's amazing. So this is the first time that they actually streamed it to the rest of the world. It was included in a streaming because it's a nightmare to get all the approvals, right? So Buffett was talking about that they had to get approvals from Disney, from every production houses who actually own those brands and on those TV series, right? So I guess there was some clipping from Office, someone from Desperate Housewives, like I said, Breaking Bad, and there are a few which I don't even know. But it's a fun. It was like they paid a tribute to Charlie, and starts with this, like, Charlie's I guess the youngest, the photo that we know about, right? So we don't want to get into the details of the financials, except the fact that Berkshire Hathaway is still sitting on, I think now it is 189. So as of end of March, it was $182 billion cash pile. Now, during the conference, during the shareholder meeting, he mentioned it is $189 billion, and it's expected to hit almost $200 billion, I think, by end of Q2. So huge cash pile. So the biggest question is, what is Warren gonna do about with that money? Is he gonna buy some company? So he did give a hint. We're gonna go back. We'll look at it little later. What else? In between, I think during the question and Q&A session, there was a very touching moment because, like, as a habit, Warren turned to his left and Warren responded to a question and then turned to his left, say, Charlie, like he has done for now like 50 plus years. And there is no Charlie there. So Greg Abel was there, and only thing Greg said was, I'm honored to be called as a name Charlie. And, he laughed it off. But yeah, and I'm sure Warren he misses Charlie because they have been friends for now 65 years working together. What else I found out? Geico, there were some questions around Geico is behind Progressive in data analytics capability. So this was the first time when they got both or maybe second time when they got both Ajit Jain. Ajit Jain is a person who manages everything related to insurance in Berkshire Hathaway. And then you have a Greg Abel, who is managing everything which is non-insurance. And I think that the knowledge is that Greg would become CEO when Warren Buffett will be no longer around. So the question was, Ajit, was, hey, Geico is lacking in data analytics capabilities. I think now the Geico has slipped behind Progressive. But Warren said the Geico insurance is still cheaper, and we are using, we're still working on becoming much better in looking at the data and pricing our risk accordingly. What else? Climate change is like inflation. If it done right, it can be the friend of the risk bearer. So there were questions around ensuring, how the whole threat of climate change could be impacting your insurance operations. Remember, Berkshire is big in P&C, property and casualty insurance. They are very big in something called climate. Oh, there's a specific word for it. I can't recall it, but it's like a cat insurance, which is a catastrophe insurance. So I think again, there is nothing to be afraid of risk as long as you can price it properly and you can get paid for it, right? So if it climate change, if it been assumed, if it been measured properly and you can get paid for it, it's a friend of risk bearer. After 2 hours, there were, I think there was a comment saying, we don't have any hesitance in putting big money in Canada if we can find a big business that can benefit from Berkshire participation. We are looking at one thing now, but it has to meet our standards. After that, like the crypto Twitter, FinTwit, not crypto, FinTwit was all right with what could Warren be looking at in Canada? Could it be one of the big banks? Could it be, obviously Warren is not big on the tech side, so won't be Shopify, but what else? I mean, Shopify is one of the biggest publicly listed companies in Canada. So there were a lot of questions around what is that he's going to buy. He also talked about a position that he said he'll be building for past 3 quarters. Maybe it could be bank, insurance, financial sector. We really don't know what. What else? Ajit Jain said no one is irreplaceable. This came from when I think someone asked that after Ajit, who because Ajit is also like 72, and Warren laughed it off saying Ajit is very young as compared to he himself, and there is no one who can replace Ajit. But Ajit came forward and said, no, there is no one who's irreplaceable. Tim Cook replaced Steve Jobs, and I'm already discussing I've discussed my replacement with the board in case I hit by a truck, right? So again, there's a great story around Ajit Jain. They found this guy, and he had zero experience in insurance industry when they hired Ajit Jain. And they hired him to lead and fix the Berkshire, I think Geico's insurance operations and all other insurance businesses that they had. But Ajit had no experience in insurance before he joined Berkshire. There were questions from Ajit Jain around cyber insurance, cyber security insurance, with all these hacks going around. I think we had an AT&T data got leaked. It was yesterday or day before. I received email from Dell.com because our account there looks like Dell data got hacked. So there were questions around how about moving into cyber security insurance. So this is what Ajit had to say. Cyber insurance has become fashionable. Like a lot of insurance companies want to talk about it. Currently, it is approximately 10 billion global in terms of a business, in terms of a premium that you can generate. At Berkshire, we are careful on taking on cyber insurance liability for 2 reasons. One, it is difficult to know the amount of losses incurred in a single instant or aggregated level, right? If one company get hacked, what's the overall liability? It's difficult to estimate for that. Or if a cloud provider gets hacked, right, what happens then? Number 2, not enough data to find out what the lost cost is. You don't know what will be the worst case situation. So he says, by default, our assumption is writing cybersecurity insurance means you're losing money. The question is how much? So he says his guidance, or maybe rather the mandate to the operating managers of insurance companies is, if your client is asking for your cybersecurity insurance, of course, it is being bundled together with the other kind of insurance that you're selling. So you can't say no, but by default, you assume that it's a losing business. Okay, so we don't want to be in cybersecurity. So thought that I had was, if a big insurance companies are not keen to insure cybersecurity, then the companies have no choice but to go overboard on, basically buying tools from a cybersecurity companies. Something to keep in mind. So this is like, I mean, if you can insure a risk, then you may not want to uh, spend money in avoiding that risk. But if you can't insure that risk, then as a company, I bear the whole risk because I can't transfer it to an insurance company. And then it means I'll be willing to spend a lot more to make sure that that risk doesn't happen in my company. So, and again, I don't know how about the other insurance companies. So if a company like Berkshire Hathaway and folks like Ajit Jain, who are, I guess, the experts in pricing the risk, if they have to say that cybersecurity insurance is a losing business, we don't want to go and provide, cybersecurity insurance, then maybe there are others who have the similar thoughts around it. So where does that leave, companies like AT&T's, Targets, or any company that have a web presence? If you can't insure the risk, then you better have enough protection against that risk, right? So that bode well for cybersecurity companies who are selling tools and technologies to protect against cyber threats. Something an investing take from here. Talk about why Berkshire reduced its stake in Apple. The answer was, I mean, it wasn't very clear answer. All he gave was that he wanted to raise cash because Warren thinks that the interest rates are gonna go high. But anyway, Berkshire has sold 13% of its Apple holding, which is equivalent around $21 billion. It still holds $144 billion, give or take, depend on what day you are looking at Apple stock. But so it is still the biggest holding for Berkshire Hathaway. Okay. On why not put capital to work, I don't think anyone at this table has any idea of how to use $189 billion effectively, so we don't use it. We will only swing at pitches like we only swing at pitches that we like, and today things aren't attractive. So there is speculation in investing community of maybe he sold his Apple so that he wants to raise a lot of cash, and when things become attractive, maybe a year down the line, maybe 6 months down the line, nobody knows. Maybe he's raising his cash to buy things at much attractive prices. Again, neither Warren knows, nor I know, nor any other financial, any talking head or on any media knows. But something to think about. Okay, so we already talked about the why did he reduce the Apple stake by 13%? Current cash pile is expected to be 200 billion. Exiting
The
Paramount.
only hint he said was that there's a possibility in that if the taxes might go up, then he gets away with a lower tax price. But not that he's averse to paying taxes. So.
Yeah, that's what he said, that currently we are paying 21%. Not a long ago, it was 35%, 52%. And he thinks that the government is going to increase the taxes because we have so much of a fiscal deficit.
Yeah.
So that's what he thinks.
Yeah.
Anyway, so he took a little bit of a gains off his Apple. Number two is maybe, holding or generating cash to deploy it in a better opportunities, which may come around in the market. I think market is a little more scared about the latter part. Does that mean is Warren looking at, oh, we may have a little crash in the market? Who knows? Neither does he. There were questions asked around Paramount investment, and he was very frank in saying we lost a lot of money in Paramount, but then he took. I mean, this is typically Warren. He said the decision to invest what was not his money manager's Ted or Todd. He said this is all by myself, and like they say, this is very typical of Warren because he always will give a credit of success to his money managers or to his team and take all the blame on himself. So we really don't know who actually decided or to invest in Paramount. Maybe it was Warren who took a decision. Maybe it was one of our money managers. But anyways, so they exited and he says we lost a lot of money. So even Warren doesn't get everything right. Right? If you can get 40% of your investments right, I think you're much better than most other investors.
How long did Berkshire hold Paramount?
I don't know.
Yeah, so you don't know. I mean, maybe it'll go up in 5 years. Like then people will get plotted because I mean,
Yeah,
some
so
people are still punting on Paramount is a good stock.
yeah, so I mean, for
Long.
now, he anyway, I think he has exited the position, which is very unlike of Buffett. But I'm seeing over the last 5-6 years that Berkshire has bought into stocks and not held for life, which is what generally we think Warren doesn't sell. I think there are some core positions which will never sell. He talked about, I guess, Amex and Coke. He said, I'm never gonna sell these things, but we saw Warren doing the similar stuff with the airline companies. We just saw them doing with the gold, and then Paramount. Yeah, there are many such instances over the last 6-7 years. Ever since I became more actively following individual companies that Berkshire Hathaway bought and sold it in a year or 2 years. Looks like Paramount is one of those. But Paramount is in an interesting situation. There is a whole tussle going between Shari Redstone and then they fired the CEO. And there was an interesting, if you're episode on Wall Street Journal around some of the stuff that's happening with Paramount. So if we want to dig deeper into it, go ahead and give it a listen. All right, a quick 30 takeaways. So we already talked about trimmed Apple by 13%. We talked about 30-minute video. Insurance still an excellent business. Ajit is doing amazing job and no one can replace Ajit. Q1 was good for Berkshire Hathaway. Company keeps compounding at attractive rates. No questions. Every time you see the word EBITDA, this is like famous Charlie Munger's quote. You should replace it with BS earnings. Berkshire more than 100 million per day currently. That's a staggering amount of a figure. Successful investing is all about having a few very big winners, right? So you'll get all of us will get a lot of stuff wrong. I think that the difference is some of your winners will give you the return which will account for not all the losses plus give you much more. The power of compounding is most underrated power in the world. Look at Medallion Fund, right? 60% return turns $100 into 400 million. Berkshire Hathaway will keep buying back shares in years to come. Don't check your stock prices daily. Yeah, this one, Coke and Amex will probably never be sold. Apple will remain Berkshire's largest position. Always look stock like a business, right? Like this is stuff that I've been talking about for years. Is good stock, bad business, good business, bad stock. These two are different. When your holding goes down, look at it. Is it that the business got broken or is that the stock got broken? Okay. Don't try to time the market. The market is there to serve you, use it for advantage. And market does provide us opportunity time and again to buy some of the stuff that we want to buy at much cheaper cost. Intelligent Investor is the best investment book ever, especially if you're interested, read chapter 8 and 20. It could become a little boring because it was written in a different generation itself. But if you don't want to go through the whole book, chapter 8 and chapter 20 are the best ones. Higher taxes, we already talked about. Yeah, Berkshire investments will primarily be in the United States. There was a question asked of Warren Buffett about Berkshire investing in India. So he said primarily we will be in US. Now, obviously, a lot of US companies have businesses globally. So indirectly, Berkshire does get a global exposure, but he does have, I mean, we talked about it. He took a stake in 5 of our Japanese trading houses. Then he bought a company in Germany, which really didn't go well, Precision Cast Parts, but primarily it's a US investments. Anyone who says size doesn't hurt performance is selling. That is true. The moment you start to grow your either your funds or your own portfolio become bigger and bigger, it is impossible to get those higher and higher gains, right? So there's a lesson in it. Any time when you hear on Twitter that I made like 50% or 100%, hey, at what portfolio? What did you start with? It is easy to make from 10K, you can make 20K. Impossible to do it if you're sitting at 1 million to make it 2 million in a year. Because the amount of a risk that or your opportunity loss is too huge. You just can't take those risks, or you shouldn't take those risks. Charlie's 2 best ideas were BYD and Costco. Feels good about exposure to Japan. The best time to sell a wonderful company is almost never. Or this is what this is like my code. I want to buy the stocks and my holding period is forever. Unless I have to sell it because I want to use the gains to do something else or that the business is broken. I don't know anything about AI. You cannot have a shareholder meeting without talking about AI, whether it is I'm going to talk about in Coupang or whether it is Warren Buffett's meeting. Geico is still an amazing business, cost virtually less. Charlie was the best partner I could have ever imagined. Always surround yourself with the people that you look up to and trust. During our entire partnership, 65 years, Charlie never lied to me even once. If there would be no risk, there would be no insurance business. Insurance is still very attractive business despite the climate risk. And finally, never bet against America. So, quick summary. Any questions on Berkshire? If you're on Twitter, there are many accounts who will give you. I think this also came from someone I don't recall. Maybe I received it in an email or whatever.
So Vivek, I know you have a like your top 15, you have Berkshire in your portfolio, right?
Yes, I
It's a
do.
top 15. Most of the leader from Berkshire are aging people, right? They are like 70 and above 70, including Warren Buffett, 93-year-old. What's your thought on that? Like, are you worried about who's gonna take over Berkshire since you have a good portfolio? I mean, good size in Berkshire. What's are your thoughts? I would love to hear that.
Okay. Yeah. So Berkshire is like I think it definitely is top 15, but I think it is right now my 2% or somewhere. We'll have to go back and look at our I think last week video where I shared my portfolio. But my thoughts around this, and this was a question that keeps coming up in I guess every Berkshire meeting for last 2 or 3 years is succession planning. And even now also the question asked is Warren is 93. What do the other operating managers do when they they need some guidance? So what Warren has already started to do is to transition all the responsibilities to Ajit and Greg. And Ajit mentioned that nowadays, if any operating managers means the managers or the CEOs of the companies that Berkshire own, they have a question, they directly reach out to Ajit or to Greg. If they reach out to Warren, he will not give them an answer, but politely will point them out to Ajit so that they become habitual to not to talk to Warren because he says, I'm too slow now. These two guys are the folks whom they should reach out to. Ajit is 72. I think Greg is mid-50s or maybe early 60s. So I think they still have a lot of years in front of them. There is already a discussion. There was some note where I read there, in absence of Ajit, They already have a succession planning. More importantly, from an investing perspective, which is where the Warren Buffett used to spend a lot of his time, Todd Combs and Ted Welchler, those folks have been managing a portion of Berkshire Fund now for years. And I think Apple investment idea came from one of those folks. To otherwise, we all know, right? Warren Buffett never looked at Apple. He was a little averse to investing in any tech company, but they proposed, one of those managers proposed for investment in Apple, and as a consumer brand rather than a tech company. So I guess there will be stock will get a hit because a lot of success is credited to Warren, but the way Warren has built the structure of Berkshire Hathaway, it's like Berkshire gets a free money to invest in the companies. And this is why the insurance business is, it's not just one, it's the whole structure that has made Berkshire so successful, because when you buy an insurance, you get an insurance and then you get the whole float of the insurance because you don't have to pay up unless there is an accident. So all that float that the Berkshire Hathaway enjoys, that enables them to buy companies at great prices or to invest in a lot of other companies. So Berkshire cost of capital of investing or buying companies is sometimes zero. Right? And even US government doesn't have that cost of capital below zero, right? Treasury is at 4%. So is that the whole structure that Warren and Charlie had built over the years? Then that has made Berkshire as a successful business as it is right now. So as long as that structure remains the same and nobody tries to, messes up by taking huge bets or try to take higher risk and try to utilize the cash and say, you know what, let's invest this cash and add some fragility to the business, I think that then I'm okay with it. So he set up the company really well.
Okay, thank you. One more question. Warren Buffett is known for not investing in a technology company, but when I was looking into what are their holdings, I noticed they invest in Amazon as well. Do you know what were their thesis investing in Amazon as a technology company or as a distributing company?
I don't know, but and probably it may not be a big part of the portfolio because it doesn't come up for discussions. They also invested in Snowflake, but that was like a pre-IPO.
Right.
And I guess these are the investments which are probably being made by Todd and Ted and using the discretionary capital that they have.
I
Like
see.
Geico has its own separate investment team apart from Berkshire. So it may have been some Geico, or it could be Berkshire, but maybe driven by Todd or Ted. Aditya, has anyone compared S&P returns versus Berkshire for 5 years? No, they haven't been beating. I don't think they've beaten S&P for 5 or even for last 10 years. And the reason is because if you look at last 10 to even for 15 years, S&P is largely driven by these big growth tech companies in which Berkshire doesn't have that exposure. Number two, Berkshire is comfortable keeping 15 to 20% in cash, right? So he is holding $200 billion in cash, and Berkshire overall market cap is what? I don't know what. Let me just look at the Berkshire Hathaway. Let's see, Berkshire market cap is what, 800 billion or something? Yeah, 900 billion, right? So 20% holding in cash. You can't beat S&P, which is 100% invested all the time, right? But what does that cash allows them to do is to build a business that can survive any sort of calamity. Be it the 2008, 2009 crisis, be it a COVID when the market tanks down 35%. And this is where I think structurally Warren doesn't want to, in order to chase a few percentage of higher returns, he doesn't want to introduce any fragility in the business, and that's why he was very comfortable in holding lots and lots of cash. This will be perfect segue into the later discussion on Howard Marks stuff, right? So and if you are holding 20% of cash, it's all not always you need to look at a return. Look at a return versus how much of a risk you are taking to get that return, right? It's always a risk adjusted return. So yeah, if someone is looking to beat S&P or be with S&P, and then you also have like 35% drawdown with S&P, live in S&P. I don't think Warren wants to do that. So yeah, they haven't beaten S&P over the last, I guess, 10 or 15 years because majority of S&P is driven by the tech side, which they don't have. I've heard.
Do you think that they'll have a good possibility of beating them in the future, given their size?
Over the long term, I mean, from now onwards, it will be very difficult because there are no businesses available.
Yeah, because 10 years is a long time, right? They haven't done it in 10 years. So people, I guess, in my friend circle, almost face this interesting question. I mean, he's had incredible success and now declares it'll be hard for them to have similar amounts of success due to their size or whatever other reason. So whenever we are now making investment decisions, it's interesting to decide between just a simple index like S&P 500 versus Berkshire Hathaway.
Sure. So I think it's going to be an anti-fragile. It's going to be a resilient portfolio, but may not be a market matching or market beating return.
Right.
So
Thank you.
yeah. Ed Johnson, I've heard it claimed that Buffett sell options too. Do you know if this is accurate, puts or covered calls? Yeah, I covered it in my first session of boot camp because everyone says options are risky, and I pulled in some examples of how he sold tons of basically put options on Coca-Cola. He sold actually market the Wall Street firms had to create special options for him, which he sold on SPX and all these indexes in 2009. So he got $4 billion as a premium, which was for him to keep. Yeah, but I've not seen in recent big ones, but yes, he does sell options to basically acquire that, to lower the cost basis. I've not heard about the covered calls, but I've seen a lot of examples of him selling put options. All right. Since we talk about the risk, let's move on to the risk first. We can do this other updates later because it's a perfect segue. We'll come back to that. Yeah. So which is risk and the cash and all that stuff. So we are just in the same, train of thoughts. So there was a memo from Howard Marks. This is a recent memo on, I think, May 8th or maybe May 7th, which talks about the impact of debt. Right? I found Housel's April 30th article entitled How I Think About Debt. So when I read about this, I'm like, okay, let me first go and read that. So let's read Morgan Housel's one, and then we'll come back to Howard Marks. Both of them are like two of my favorite writers. Japan has 140 businesses that are at least 500 years old. A few claim to have been operating continuously for more than 1,000 years. But that's a longevity. It's astounding to think, 500, even if you talk about 500 years, America wasn't even founded then. So dozens of wars, emperors, catastrophes, tsunamis, depression, so on and so forth. And those businesses still operate generation after generation. These businesses are called shimise, and they share a common characteristic. They hold tons of cash and no debt. Right? Now I understand why Warren Buffett would like to hold $200 billion of a cash and not try to chase. I mean, he's happy with 5% he's getting anyway in treasuries. So even if he doesn't do anything, it's like a $10 billion of risk-free that comes to Berkshire Hathaway year after year, right? But if you have to build a company which stays on for 500 years, Tons of cash, no debt. Because when it comes to the debt, that defines your future. And when your future is defined, hope begins to die. Because it constricts of your optionality of what you can do when the times are not good. So that cut both ways. And that's why you would hear me talk, don't talk about leverage stuff. I don't like taking margin and investing. I don't like taking HELOC and investing. I used to attend another meetup and stopped attending that meetup after the person talked about how we should lever up and put everything in a stock in 2020 because it was an easy choice to make, right? You get a HELOC or 3%, 4% and invest in stock market or invest in NFTs. But what you miss out is, hey, things will change. So anyway, not only the hope begins to die, but the number of outcomes you can endure too, it does as well. So imagine this is our life, which is ups and downs, volatility. This is what happens in life. Illness, movements, changes of your heart, divorces, wars, pandemics, right? With no debt, you can withstand a lot more ups and downs in a financial life as well as in your personal life. A few extremes might hurt you, but you'll still be okay. You take on a little more debt, the amount of the variations that your life can sustain starts to squeeze down. Take a lot more debt, lever up. As long as the things are going in your favor, you will be Einstein. People call you genius, right? The moment the volatility in markets as well as life start to make these big swings, which it will, right? This is what life is. We are not defined by a rule. This is what life is. This is what market is. This is what finance is, that things are unpredictable. So the amount of those swings that you can withstand with large amount of leverage, that becomes less and less. And as that increases, you narrow the range of outcomes that you can endure in your life. And that's what all the bankruptcies happen. Why? Too much debt. Too much debt. So, but debt, generally that they'll talk about that in a different way, right? If you were to increase the return on equity for equity shareholders, and this is what the PE firms will do, is they'll lever up the companies on debt. And no surprise is that many companies that emerge after PE don't survive for too long in the markets because, hey, they levered it up with the debt to increase the return on the equity, which the PE firm will accrue. But that debt, if not managed well, just kill those companies. I hope to be around for 50 years from Morgan Housel. What are the odds that during those 50 years, I'll experience one or more of the following: war, recession, terrorist attack, pandemic, bad political decisions, family emergencies, unforeseen health crisis, job losses, career transitions, like children not listening to you, other mishaps, accidents? Odds are 100%. This will happen. When you think of it like that, you take the debt's narrowing of survivable outcomes seriously, right? Start looking at debt from that perspective, not only from one perspective where I say I can use debt to generate, to use debt to lever up my portfolio so that my return on investment become higher. For sure, it will be higher. But what we also need to understand is what am I gaining? What's the risk that I'm adding to my portfolio? And then when that happens, let's say the interest rates have gone high. Now, all the companies or the individuals who had levered up, taken HELOCs, and invested in the stock market in 2020 or 2021, when stock market went down in 2022, interest rate starts to go high, they'll start complaining about Fed. It's not the issue of Fed. It's like you built a house without any solid foundation. Your foundation was on bamboo and your house is fine. It will stay fine as long as there is a no mini earthquake. The moment you get a mini earthquake, your house will crumble. Then don't blame the earthquake. Don't blame the earthquake then. So this is what debt do to your portfolio. Everything will look great as long as things go fine. But the moment and there will be moments that market turns around, something happens, you have unexpected expenses, and for whatever reason, like interest rates have gone from 2% to 7%. If you have taken those attractive loans at 2%, now you might be paying whatever 7-8%. It upset all the equation. And then don't blame Fed that Fed has increased interest rates. As we did it to ourselves.
Vivek,
Yeah.
I hear recently that insurers aren't letting people they're getting rid of the home insurance. That's kind of like robbery. They've been paying for so many years, and then they just not allow them. I mean, that means they've been robbed for a few years, or
So home insurance is different. We can come back to that topic.
Okay.
I know
Yeah,
why
thank you.
why in California the companies are leaving and not renewing the home insurance. Yeah. Financial volatility is a very obvious one. You find yourself unable to make debt payments, but there is also psychological volatility, right? If you take a debt. I'm not an anti-debt zealot. There's a time and a place, and use responsibly. It's a wonderful tool, just like options. Use responsibly. Options are a great tool, but then you also hear the stories of how people have wrecked their portfolio by dealing in options, right? Once you view debt as a narrowing what you can endure in a volatile world, you start to see it as a constraint on the asset that matters the most. Having options and having, okay, this is not the financial derivative options, but having more choices in life and in portfolio and have the flexibility. If you don't have that flexibility, we'll basically chicken out of the market or will be forced to leave the market because you got a margin call and your broker sold off your stocks when there is a best opportunity to actually dig deeper into market and buy the stocks at the cheapest prices. So yeah, if you're here to find out and listen about how we can lever up and make tons of returns, I'm never in favor of that, right? Coming back to Howard Marks. Okay, yeah, clearly all else being equal, people and companies that are indebted are more likely to run in troubles than those who aren't. A home or a car that hasn't been used as a collateral can't be foreclosed or repossessed, right? It's a presence of debt that, oh, just one second. I'm hearing some humming sound coming out of my speaker. Okay, went away. Yeah. All right. Geez. The amount of borrowed money or a leverage that is prudent to use is purely a function of riskiness and volatility of the asset that it is used to purchase. The more stable the asset, the more leverage it could be safe to use. The riskier the asset, the less leverage. And stock market is a risky asset. But cryptos is a risky asset. Don't lever up or don't borrow to invest in an asset where the outcomes, the volatility or the, you can't predict what the outcomes of would be. Don't borrow and invest on those monkey JPEGs in 2021. They worked great while it worked, right? In 2020, those crypto monkey JPEGs, all of them are dead now. Don't use this is basically my comment. Okay, don't use HELOCs, don't buy crypto, don't lever up to buy cryptos. Okay, let's talk about next one. The reason for taking on debt, why investor take on debt is something called leverage, right? We talked about it. Simple to increase the so-called capital efficiency. You can get at a much cheaper rate. Not nowadays, but not far, not a long ago, debt was available at almost 0% rates, right? Debt capital is generally cheaper than giving up a portion of your equity because once you've given up a portion of equity, you have given it for life. right? It's like a royalty that then you'll continue to pay to the shareholder. Thus, it is efficient to use it in lieu of equity. In casinos, I've heard the pit boy says, the more you bet, the more you win when you win. Right? Likewise, for the given amount of equity capital, the more debt you use, the more you lever up your balance sheets, the more assets you can own, the more assets you own, the greater your profits will be. But when things go well, pit boss never says the more you lose when you lose. That doesn't happen. They won't say it. That if the things go bad, it become much worse. Your company become much worse. Your portfolio become much worse than if you were not levered. So think about if you're trying to take some margin and all that, think about, are you, is this rosy situation gonna be always there? 2023, yeah, you could have borrowed money at 4%, market return like 26%. Is that going to be the case in 2024? Who knows? The magnification of gains and losses from leverage is symmetrical. A given amount of leverage amplifies the gains and losses similarly. It cut both ways. There's no free lunch. But levered portfolio face a downside risk to which there is no corresponding upside, which is the risk of ruin. And this is where, at least I want to focus a lot more on building a portfolio that will allow you to sustain all the volatility of the markets. Right? Even if that means you have to give up a few percent of gains, it's okay, because this risk of ruin, you just can never recover from it. And what I mean by this is like you getting margin calls because you took up too much margin. Stock market went down 5%. You didn't have enough capital to hold those margin positions. Brokerage will sell the best companies that you may have held in your portfolio, and stock market recovers, but you are already out. The idea is not to, can I get some additional percent? The idea will be, hey, when they're actually, that you will be forced out of the game, right? And that is, you can't recover from it. Okay? Lenders can cut off the credit. Investor can become frightened and withdraw their equity. This happens if you are investing, let's say, and that's why I don't invest. I mean, if you're investing in a VC, etc., understand that majority of your VC investment will go down to zero. There'll be only very few successes. And if you need money, if that forces you to take money out of your stock market, then don't invest in VCs trying to hit it, 1:100 or whatever, 1:1,000% returns. Okay, let's continue. The problem is that extreme volatility and loss surface only infrequently, so we forget about it. Oh, come on, nothing has happened. It's okay. You can take a 4% loan, and on an average, S&P gives 10% anyway, which is true. You look back at the history of S&P 500, on an average, you'll get 10%. But, to get that 10%, you have to bear the 30% drawdown in any year. And if the amount of a leverage or a debt that you've taken can't allow you to go through that 30% drawdown, then you are cut off way sooner and won't be even there to enjoy the fruit of compounding of 10% CAGR. Let's skip this. Let's see. In all aspects of our life, we base our decision on what we think probably will happen. And in turn, we base that to a great extent of what usually has happened in the past. Right? We kind of assume, history repeats itself. It doesn't work that way. Right? Okay, what else? All right, so I do want to read the rest of it, so bear with me. Cycles in the use of leverage. In my second book, Mastering the Market Cycle, one of the longest chapters and probably the most important is the one that I hadn't planned when I sat down to write, the cycle in attitudes toward risk. Investor psychology has a dominant influence in the market in the short run, And the attitudes that motivate investment decisions are often cyclical in nature, driving markets to irrational extremes and then correcting in opposite direction. We have seen all this during .com, for .com companies, and then for SPAC companies, then same thing for crypto, and then in 2022, all the tech companies, right? We have a euphoria, and then boom, completely desperation on the other side. Attitudes that govern the use of debt capital are examples of this cyclical process. When things have been going well for a while, when asset prices have been rising, investment returns have been positive, and the use of leverage has paid off in form of high returns, investors view leverage as benign. It's okay. It's okay, we can borrow. Hey, it's been working. The favorable aspects of leverage become well recognized. You start to look at, instead of looking at return on investment, you start to look at return on equity. The negative potential is overlooked. Investors became interested in employing more and more leverage. Lenders will be providing more and more, right? We saw this in great financial recession, right? Zero checks and balances on what your income, right? It's like a self-declared income. And yeah, I make $100,000 per year, but yeah, I'm okay to buy 3 houses, each worth $400,000. Right? Your capacity to take the risk increase because you've seen some of your other friends have become rich by borrowing on leverage. Regulations and mores governing the use of leverage become more and more permissive. But when event turns negative, which it will, the process goes into reverse. Leverage is penalized, not rewarded. Thus, its use completely declines. More importantly, lenders provide less and try to demand repayment of outstanding leverage if they can, leading to negative consequences for borrowers. In this way, as we so frequently see, psychology often strays from the happy medium and moves toward extreme high that precedes a painful losses with extreme lows that are reached. The source of losses from excessive use of leverage might be best understood through an adaptation of his new favorite quote, the Prince of Time, in which is, okay, yeah, there was it's a good one, Easy Money, where he talked about, around Edward Chancellor's book, using debt prudently. As with so many aspects of investing, determining the proper amount of leverage has to be a function of optimizing, not maximizing. So there was a question around, I think Berkshire Hathaway is not looking to maximize the returns. They're looking maybe to optimize the returns. Given that leverage magnifies gains when there are gains, and that investors only invest when they expect to be gains, it is tempting to think that the right amount of leverage is all you can get. Come on, let's lever up. But if we bear in mind a leverage potential to magnify losses when the losses happen, the risk of ruin under negative circumstances, and I think third thing we should add here is the lack of optionality that debt puts on you and your portfolio, from Morgan Housel's article. These are the things we have to bear in mind. Successful investments, perhaps enhanced by moderate use of leverage, should provide good enough return, not the maximum return, but good enough return. Something few people think about in good times. In good times, 20% return, no one is happy. I want to have a 60% return or 100% return. So here's, I sum it up in Volatility Plus Leverage Equal Dynamite. I'll have to go and read that article. Looks like that's 2008. I haven't gone back till 2008 to read Howard Marks articles, but let's see what he summarized. Clearly, it is difficult to always use the right amount of leverage because it's difficult to be sure you're allowing sufficiently for risk. Leverage should only be used on the basis of demonstrably cautious assumptions, and it should be noted, if you're doing something novel, unproven, risky, volatile, or potentially life-threatening, you shouldn't seek to maximize the returns. There's a time to think about maximizing the returns. There's time to think about not losing what you currently hold. Instead, err on the side of caution. The key to survival lies in what Warren Buffett constantly harps on is margin of safety. This basically picked up from Ben Graham's book. Using 100% of leverage, one's asset might justify is often incompatible with assuring survival when adverse outcome materialize. So it's more about, we do say market returns 10% on average. The question is, will our portfolio survive to enjoy that gains or not? The riskier the underlying asset, the less leverage should be used. Conservative assumption on this subject will keep you from maximizing gains, but possibly save your financial life in bad times. So that is, I don't want to know, I don't want to compare how much percent return did anyone make this year. It is immaterial. But everyone wants to come and talk about how great their portfolio is. You'll see this all on Twitter. When the times are good, I made 50%, I made 100%. Many of them don't survive one bearish move in the market. The right way to think about that, maybe the best captured by oldest maxim. There are old investors and then there are bold investors, but there aren't many old bold investors. Oh, I like this. Means you can be bold and lever up your portfolio, but you may not be around for long to call yourself that I've been old investors, right? Using a moderate amount of borrowed capital balances the desire for enhanced gains against the awareness of potential negative consequences. It's only this way one can hope to attain the longevity of Morgan Housel's 5-year-old success stories. I don't think anyone can talk about or write about the risk as good as Howard Marks. His books and his articles are amazing when it comes to risk in portfolio. So if I haven't read about Howard Marks, I would strongly suggest it'll help you and your portfolio in designing the portfolio or managing the portfolio for long term. If you're in the market for a year, 2 year, 5 year, 10 year, do whatever you want to. Right? Then you may not have to think about risk because come on, 0% interest rates have stayed us for 15 years. Now, all the strategies that had worked in 0% interest rate during the ZERP environment, whether you're running a company or running your portfolio, managing your own money, don't work anymore. But if you're trying to build or portfolio or a company for survive for next 50 years, and I think I'll be around maybe for another 30, 40 years, right? Then we have to really think differently. And that is why I always say, don't follow what others do. You don't know what game they are playing. You may be playing a 1-year game. I may be playing a 20-year game, and someone else may be playing a 1-month game. So the way we invest, the way we talk, the way we look at risk, the way we look at market is going to be completely different. And I don't hate day traders, but they're playing a different game. I'm playing a different game. So it's not like it's said that market is zero-sum game. It's not zero-sum. It's not zero-sum game. It's not that if I won means you have lost. We are both maybe playing a completely different game in the same market using the same instrument. If you are looking to day trade, your target maybe have to make $500 per day. And as long as you made that in an Apple stock, you might be okay to sell the Apple stock. Right? So that if Apple goes down, you don't lose that. I may be willing to buy the Apple because I want to hold it for a much longer time. You sell it, I'll buy it. It's no zero-sum game. We're basically playing into completely two different games. Every investor is playing his own game. What you need to understand, instead of following me or following anyone else, is what is your game? What is that you want to play in this market? Okay. That's it. That's my spiel for about risk and Howard Marks and Morgan Housel. Okay. I know it could get boring sometimes because, come on, I didn't talk about some great indicators that will help you to identify that, when the stock is going to break out. But that's a different game. I don't play that game. All right, let's get back to the other stuff. Let me read some comments first. When the market crashed in 1987, famous investor John Templeton was guest on PBS Wall Street. He said his lesson was, don't buy stocks with borrowed money. Yeah, I agree. Brand says, I like getting the most anticipated weekly analysts from this Reddit. This is the one starting May 13th, currently WMT. Yeah, so I generally, I pick it up from, let me just go to the Twitter guy. I just posted today. My account is being migrated from TD Ameritrade to Charles Schwab. Earnings whisper. Can you post some good chart? I didn't look at this. So what's happening next week? Monday, nothing for me. Stone Co, as you guys know, I talked about Stone Co. Has a lot of covered calls because after I looked at its annual report, I was not that happy about it. So I'm like, okay, I'll be happy to if those get called away. So Tuesday is going to be busy. Oh, Tuesday early morning, Alibaba, C Limited. Okay, so and later on you got a new. I haven't yet opened a position on new. Been hearing about it a lot. That's it. Nothing. Okay, Walmart, Baidu. I have some Baidu. Doximity, would like to see what Doximity. Yeah, but it's much easier for me. I think this week was really very hectic. At some bigger position sizes, all reporting earnings. Next week, much better. HD is a good one. Yeah, there's HD also reporting on Tuesday before morning. Then we got to grab, yeah. So I will look at Stone Coast, C Limited. I guess 2 or 3, that's it. I don't have a direct exposure to HD. I basically, it's a part of my SCHD ETF itself, dividend ETF. As a guy no, I'm currently not looking to add a ticker in my portfolio. So I'll still, I'll look at HD. It does tell us about the overall economy. I think from that perspective, yes, it is important. UA may be good as it's a new year with new resolutions that people have. Wasn't that is that a UA brand or where I think it is UA, right? They ventured into some wearable tech and the stock got beaten down. I mean, it was a very I think it was Under Armour when the yeah, I guess it is Under Armour. They kind of diversified and the founder has completely different ideas. All right, coming back to this week, sector-wise, looks good, man. What you may be surprised is energy and utilities are doing much better than IT, at least for this week. Right? S&P almost 9.3% in 4 months or maybe 4.5 months, which is still great return in 4.5 months. But utilities had a huge run up. I think it was up like 5% in a week, and now it is up like 12.43%. So this is XLU, and as you can see, what a great run up this XLU had from here all the way till here in a couple of weeks. So maybe utility is a new AI play. Generally, when the interest rates are higher, utilities, they don't perform well. But it has defied the general convention. And XLU, at least, has become like one of the best performing sectors for this year. And maybe it's driven by all that demand of energy from the AI. That's one area. wherein if you are having all this AI revolution, all those energy guzzler chips that you need to use to run your LLM models, and who's going to supply all the power to them? So now I've also seen, and I think it has also led to increase in some of those nuclear fuels like uranium and all that stuff. U is one. Okay, so let's go to. Then there are other U, R, and M, uranium miners. So there is a talks of restarting some of the nuclear power plants to meet these energy demands. Energy utilities are part of values. I think of recession of upcoming CPI, PPI. I mean, it doesn't really matter what I think about it. We've been thinking about recession like whole 2023. People much smarter than me, having much better access to much better data than me, were thinking about recession in 2023. Didn't come. So I don't know, maybe the recession will come in when when majority is not expecting it. Because it could also be like self-fulfilling, right? If you think that the recession is going to come in, you start to start to prepare your company accordingly, and which basically averts the recession. So I don't know. Will there be a recession? Who knows? Will there be a stagflation? Jerome Powell says he doesn't see a stag nor inflation. So I have no idea. And I don't think we should even worry about it, even if it is happening or not happening. Good businesses, good companies with strong balance sheets, doesn't matter for them. Yeah, if you are invested in some hotshot company that can survive only in good years, and there's nothing wrong in investing that. I mean, I hold many companies which are down 80%. Just that make sure your position sizing is appropriate. Those companies will have problems. So nowadays I don't even follow CPI, PPI. I realized after years that this trying to follow the macro stuff really doesn't help. So I'll only talk about macro when FOMC meeting is there. Other than that, doesn't really matter. S&P performance, utilities like all green. Tesla is down 7% for last week. This is very different from what how Tesla behaved after their earnings. It had a huge run up after earnings, and now it gave up some of them. Disney was down 7%. Of course, earnings came out. Market didn't like the earnings. Meta is up 5%. I guess this is just catching up with the drop that had happened after earnings. So it's just trying to get back. I don't know why it was punished after earnings though. Anyway, but market does what it does in after earnings. You can never predict what's going to happen, and that's where you get some opportunities. Fear and greed index. Now we're in neutral, so not still greed. So I'm still trying to hedge the positions, not getting too aggressive with the hedging. Will do once the market moves into the greed side. Right? When everyone is greedy, that's the time to be cautious. What else? I see a common recession signs or info help to reduce some of the recent buys from some of the positions to cash to buy them back with the better prices, right? If you can accurately predict it. The problem is no one has been accurately able to predict it except some folks on YouTube and Twitter. And that's a problem. You listen to any successful billionaires not by running companies, but billionaires through investing, but they have to talk about recession or macro, so it's completely worthless. It hasn't helped them in building billions of dollars of wealth. Listen to what Howard Marks says, Stanley Druckenmiller says, Warren Buffett says, or pick another fund manager of your choice, Morgan Housel, if you want to pick him. No one worries about macro. Says, I don't know who said it, but they say there are two. You should think about, you should worry about the things that number one is knowable. Number two, it does matter for investment. Recession happening or not happening, it does matter for recession, but it is not knowable. That's the problem. So yeah, I realized, I don't want to waste my time or spend my time on trying to figure out around whether recession going to happen or not. I'd rather control what I can control, is look at the companies and see what kind of companies or businesses am I holding in my portfolio. If we see a recession, how many of them are gonna get crumbled? That's the only thing I can control. I can't control that recession will happen or not happen. Ramesh, I have a question about a trade to discuss. Yeah, go ahead. You should be able to unmute and talk. Okay, that's too long for me to even read through it. If we can just talk through it, that'll be much better. Okay, so if time permit, we can come back to that. Yeah, it's too long. Quick update on crypto. 13F continues to roll in, and two things that surprised me most was Mass Mutual and Wells Fargo buying crypto ETF or Bitcoin. Unable to mute. What's the deal? You're unmuted already.
Oh,
Yeah, I can hear you.
can you hear me?
Yeah, I can hear you.
Okay, I have an option trade for May 17th, ASML. If we just read the top bracket, that will be my question. And the rest of it is my thought process. So I just want to understand what would be the trade I should be doing.
May 17, 9:35 call. So
I
it's
don't do spread like you do. And the question is, should I roll it or
so is it
what
a
would be my choices?
is it a naked one?
No, covered call.
It's
I
a
never
cover.
sold any
Okay.
naked calls. Yeah. My cost basis is low, gain will be higher, which I'm trying to avoid. But if I do following things, which is like a rolling, taking a loss on a higher premium that I had to pay to buy back. And if it goes through, I just wrote down the whole story rather than try to describe.
So if not assigned, again, I don't know if think or sim will work fine right now or not. What's the extrinsic value left in your option contract?
Well, I'll be thinking, well, it may be assigned. It's not there yet. I sold it for 935. Stock is trading around 930. So this scenario may not even play if the stock stays below 935. But if it does, that's my planning for now because I have only 4 days to decide.
Yeah, but right now it is still out of
Yeah, I'm safe. If the stock goes higher, like it did yesterday, $14 or so, it went up. That's why it's close to the risk.
So two things. One is at this point of view, either if you can watch the stock closely and then see if it goes higher. I mean, if it actually becomes out of money, then see what the extrinsic value is. Because if the extrinsic value becomes low, then you will definitely be at a quick risk of assignment. If you can't track it closely, then options are either you roll it out, but you're not able to get additional premium for rolling it out.
I am. I always sell at a credit, roll it higher, and I don't care about the time. If I had to wait 3 weeks, 4 weeks, I don't worry
Yeah,
about
so
it.
maybe so what you could do is maybe sell it at a higher and maybe buy a long call, convert it into a spread in case after Nvidia earnings. I think Nvidia is reporting some 20th or somewhere.
Okay.
We don't know what may happen after Nvidia earnings. What if the stock goes to 1100? That may be
This is this is ASML, and
correct, but depending on how NVIDIA reports, all
yeah,
the
same
tech
time. Sure.
companies may
Yeah. Okay.
may fluctuate a lot.
Okay, so I know you like to do spread, which I don't. I rather go for a higher co sorry, a lower premium, but at a higher basis.
Yeah, that is the option. You maybe roll it to higher one, but then may have to pay out of a pocket.
Well, yeah, but I'm selling at a credit, so I will be still ahead. So instead of selling for 935 plus the premium, I'll be selling for 940 plus $9 gain, which is a credit amount.
Yeah,
Well, why don't I send you a message rather than taking up everybody's time?
yeah, let's do that.
Yeah, okay, thank you.
Okay, so, coming back to this. So the crypto, I was surprised to see Mass Mutual and Wells Fargo Bank taking exposure to Bitcoin ETF. Mass Mutual had done it in 2020 or 2021, 100 million Bitcoin on their balance sheet. And after that, we didn't hear about it. So I don't know why the insurance. I mean, I'm happy that the insurance company is putting Bitcoin and now Bitcoin ETF as a general reserve on their balance sheet. Wells Fargo Bank was really surprised. So that's this is the third largest bank in US. So why is bank interested in holding Bitcoin on their ETF? Of course, you will see JP Morgan also, but JP Morgan is a market maker. So I don't put much credence over them holding. I mean, them holding a Bitcoin is a part of a regular market making job, not that they really want to hold it on their balance sheet. Similarly, Susquehanna and all that, they all report it, but they are all market makers. Rubric Capital has got 60 million, Symmetry Investment 60 million. Again, Eric Balchunas is a good guy to follow if you want to track. He's an ETF expert with Bloomberg. What he had to say was, what is notable in my opinion is sheer number of holders that each has so far. IBIT is up to 250. So these are for Fidelity, Bitwise, ARK shares, and iShares, which is BlackRock's. So number of firms that have to file 13F means if you're holding more than or managing more than $100 million of capital, and then you have to file with SEC a form called 13F, which tells you what your holdings are. And it says, I'm surprised to see, so many firms actually have exposure to these ETFs. There are a lot of other ETFs that were created in or around the same week. Right? YieldMax, Roundel, Bitcoin, whatever, CCM Global Equity, maybe one or two funds took an exposure. Where when it comes to these Bitcoin ETFs, the sheer number of funds that have taken exposure is huge. So anyway, that was on the crypto side. Nothing much. How is crypto doing? Let's go to CoinGecko. Oh, it's right here. It's been a range bound. I mean, at least it's been Bitcoin has been a range bound now for almost a month. I think after making its high at 73K in March, it's been fluctuating between this whole, I think over the last month or so, between 65 and lowest it is 55, but between 60 and 65. So it is what it is, right?
Vivek,
Yeah.
can you explain what Dogecoin does now?
What is Dogecoin doing?
Doggy coin.
No, I mean, I know, but what did Elon Musk pump it again or what? Well, that's the only.
Yeah, I think he's accepting some payments for Teslas with a Dogecoin or something. Musk.
So I'll take Musk seriously when he buys Dogecoin and keep it on Tesla's balance sheet. No, it hasn't done much. I mean, Dogecoin hasn't been almost for a month. It hasn't done much or anything. No, I don't think. I mean, anyway, first of all, no one will be selling crypto to buy Teslas or buy anything because of the tax implications. So all that is good from narrative perspective. I don't think it's practical in US. Outside of US, yeah, you can go and buy coffee using Dogecoin or any crypto stuff. But in US, trying to buy things through crypto is a tax nightmare. So I don't think folks will be willing to do it. Now, Elon is Elon. If he doesn't have anything else interesting, or maybe we should look at what else is he trying to divert our attention from that is now talking
Excuse
about
me,
Doge.
Elon is a crummy chairman of Tesla. He's the builder, but he is a crummy chairman of Tesla.
Yeah, I'm a shareholder.
Oh, sorry, he's a crummy. I mean, he shouldn't be wasting his time on Twitter. Like I said, he was a very good visionary builder, taking advantage of everything. But now, for the last 4 years, he hasn't added value to anything.
So this is what it is, right? So things comes in a package. I can't tell God to give me only the genius part of Elon and not his eccentric part. He's a package, like it or hate it. He's got his own genius stuff, plus he's got his own shit stuff for pumping Doge and talking crap on Twitter. But he's a package, right? We can't pick and choose. He is what he is. But all we need to do, which I'm well aware of it, is as a shareholder, I know what I'm dealing with. You know who we are sleeping with. It comes with the package. So Chandra says very right, Sam. Yeah, I mean, my worst fear on my Tesla holding is Elon Musk. He's the biggest risk and he's the biggest asset to the company. You don't have so many, I've not seen anything else which is the biggest asset as well as biggest risk. But Elon is for my Tesla position. So what did I buy or sell this week? A little bit Meta, Airbnb, Coupang. Just an opportunistic buy. What did I sell? I sold a little bit of Melai, Mercado Libre. Not that I'm bearish on this one, but just that I had a call spread that was completely in the money and I don't want to get my shares called away. So basically I sold some shares and closed the call spread. And these are the shares that I had bought at around 1475. And I talked about it in April when I bought this, saying I bought it because my put spread, no, I think, I had a put spread, but then the stock was so down and I bought the shares anyway, and the stock ran up all the way, and my call spread is in the money. So anyway, so nothing more to read into it. I'm still bullish about the company, and this is still my biggest individual stock position. But I want to be transparent every week what I bought and sold, and these are the stocks that I bought and one stock that I sold. All right, last thing before we get on to earnings. I read in Barron's, looks like it came on April 29th, but I got a time to read that early day before yesterday. And the article was talking about, and this is again very timely because we are talking about options and options boot camp. The article I thought I'll share, this is again very timely, is talking about, given the little bit of uncertainty in the market, wherein the investors are demanding, show me, just don't tell me, but show me where the returns are. Volatility is higher, and this basically this talked about the blowback that we happened in April, right? April, wherein the market lost 5% in April. S&P was down 5%. And so that's why I think it's the end of April, this came out. So the blowback reinforces our long-held belief that investors might think that they own stock, but they own volatility and they don't know about it. Option-centering investors, on the contrary, should be pleased with the current environment. When the VIX was higher or when the markets are uncertain, that's a time when we can do little more positions, right? Instead of doing one contract, maybe that's a time when I can do two contracts. Uncertainty increases the IV, often beyond what is merited, and that better rewards option sellers. That's all great. Few investors are skilled enough to trade options for the sake of options. that's the point that I've been talking about it, that everyone should use it. As a normal individual investor, you and I can make use of options to manage our portfolio. That's why it's better for stock investor with deep knowledge of their holdings to use conservative option strategies. Two strategies that we talked about. One is, if you have a conviction on your stock, sell cash secured puts when the stock goes down, right? You got a higher IV, you can get paid much higher premium, and you anyway want to own the stock. Instead of putting a limit order, sell cash secured put. Because when the fear premiums are elevated. Similarly, any concerns about stock that you own and you may want to sell can be handled by selling call when the stocks are rallying. This is our bootcamp drill number 1. Use option, use cash secured put to buy the shares, sell covered call to let go the shares that you're okay to sell. Right? Second point, don't trade options just because volatility high and premium are juicy. Remember, drill number 2, rookie mistakes, newbie mistakes in trying to sell options. Hey, I'm just bought the stock so that I can sell a premium against it. No, options premium is a icing on the cake. Make sure you love the cake. So same point in balance. When I was reading, I'm like, oh, that's very timely. We just talked about it. Use them to express your view on stocks. Trade puts only on the stocks that you want to own. If you thought I was just kidding, balance says the same thing. No one really knows what's happening. I don't know when the recession is going to come. I don't know what the CPI print would be. It's unclear if you are about to experience a stock to bond regime change or if 10-year treasury is going to hit 5%. So be reactive, not be heroic. You don't get extra points for difficulty or for taking on or for your heroic efforts in stock market. So don't go too big trying to be a hero. Be incremental when you act. Scale into position, don't trade all at once. Rookie mistake number 2. Pick up one strike and go everything. If you want to have a capital to do 5 contracts, you do all 5 on one day. Spread it out. We already talked about this. Monitor VIX future, which determine VIX option price. I haven't covered this yet because we haven't yet gone through the option pricing. But we'll talk about it when we talk about option pricing is how to determine whether the overall market has got better, you can get better premium or not, which is to monitor either VIX futures or you can just monitor VIX spot prices. I love the last one. Remember, bad investors think of ways to make money. Good investors think of ways not to lose money. Or I would say new investors, when you're trying to build your portfolio, only think about making money. And next, once you have wealth, you think about not to lose money. And I think that's way more important is how not to lose money. And that's why we use options to give us a margin of safety, to give us a room for error, to give us ability to be wrong and still be profitable as long as we're not way off, to reduce the risk in the portfolio. Then why not use options? Why not? This is very different from what you might hear in traditional financial journals, which says options are risky. No, they are not. It's just that how you use the tool determines the risk in what you're doing with the tool. Cool. All right, let's talk about bootcamp. We drill number 5 already scheduled on Meetup. We're going to talk about checklist for opening an option trade, right? How do you pick up a strike price? What option strategy, depending on what your outlook is. And now we're going to talk about, since I've covered the spreads, so I'm only going to focus on the one with the defined risk and not on undefined, like not going to talk about those strategies. Expiration date, what are the considerations should go into it, right? IV, when is the right time? And there are other factors. So that will be our topic for drill number 5. Like I said, it is free to attend. And those who attended, I sent you the homework. Please respond to me with your homework. And this is the link to register if you're interested. And if it is the first time that you are dealing anything related to options, I would suggest you go and review the previous 4 boot camps. Otherwise, it is like you'll be lost because we have covered we covered a lot of basic stuff in a prior boot camps. So, any questions? Or if you have a question on the previous boot camp, on the homework, ask me in the boot camp channel of our Slack group.
Did we get homework for the last bootcamp session? I missed that.
I sent an email.
Okay, let me take a look at it. Okay, thank you.
So let me just pull that up. So anyway, yes. Okay, so this is what I sent, right? Your homework was to basically execute a put spread. Okay, sell a put spread, sell a call spread, share the trade on the following metrics. What's the max risk if both the legs are in the money? And we talked about in the money, out of money in drill number 3, right? Max profit if both the legs are out of money, and what's the return on investment? What will you do if on the expiration day, you are seeing that if it is a spread, the stock is actually between your 2 strike prices, meaning one leg is in the money, one is out of money. What are you going to do? I want to understand the thought process. Okay. Yeah, okay. So I don't think I've mentioned this. So those who will be attending for the first time, this is where the recordings are. I would strongly suggest you go through the other basics first before you attend number 5. It's like we're building upon each other, right? So otherwise it will be waste of your time, 2 hours time to go through it if you're not done the basic stuff first. All right, jump into earnings. Anything else? We'll spend maybe 20-25 minutes into earnings and then call it a day. Alrighty, let's get into earnings. Let me bring up. So first is, which is the first in agenda? I don't think trade desk. I'm completely ready. Let's talk about Coupang. Anyone needs introduction to Coupang? Any holders of Coupang? Shareholders, come on. Now, some of you probably hold it.
I'm a wannabe.
You're a wannabe. Okay. Anyone actually hold Coupang? Little bit about Coupang, please. Okay. We'll talk about it. No shareholders? No, traded options last year. Okay, so let's talk about Coupang. So since you said, let's first time, when did I review this? S1 review. 21 was the first time when we actually reviewed the company. And I did it, I think, during those meetup. I don't know, it's almost now 3 years old. So founded in 2010 by Bom Kim. He's still the CEO. So net, again, I'm not going to go through the whole S1 review. Mission is to create a world where customers wonder, how did I live without Coupang? That's mission statement is still the same. If you hear Bom Kim on conference call, etc., he's still focused on, we want to create a wow factor for our customers, and customers would worry, how did I live without Coupang for so long? Okay. So it is fondly known as Amazon of South Korea. Basically, it's an e-commerce company. And the dynamics of South Korea and US are different. South Korea, it is very what do you call dense population, and a few things that stand out for them is their wow membership and rocket delivery. Means if you are able to place an order before midnight, it will be delivered to you before 7 a.m. So things like, oh, your kid come from, school, and suddenly the night she tells you, Mom, I want these things. I have a project in the school tomorrow and I need to take these things in school. And she's telling you like 11 p.m. when the rest of the market is closed. I mean, the stores are closed. You can go to Coupang, order for it, and those will be delivered at your door before 7 a.m. So they call it a rocket delivery. Skip all that. Yeah, so that's called the next delivery, last order by midnight. They have a membership program for monthly fee for the WOW members. Rocket Fresh is their grocery stuff. They have a hassle-free return. You don't have to go to UPS equivalent. You can just leave the package outside your door. They'll come and pick it up. And then they also introduced Coupang Eats. So this, I think I did modify it recently because some other things were not there earlier. They introduced Coupang Eats, which is just like Uber Eats. And then of course, Coupang Pay, which is their fintech subsidiary. And the latest one in Coupang Play, which is a subscription-based video streaming service. So almost equivalent to, what basically Amazon plus Uber does, right? And these, I think, is just a distraction. I don't know why they're doing it, but now they have an outsourcing service called Coupang Flex. They don't really talk about this. Advertising is a new business. So these are kind of a different revenue sources for Coupang. Okay. So e-commerce company plus payments company plus Uber Eats. So let's skip to the latest earnings. Nope. Where are we? Latest one. Cool. Okay, this is May. Okay, so somewhere, I think in April or March, Coupang had acquired Farfetch. Farfetch is a US based company which used to sell. Let me just go back there. I think there was some acquisition on Farfetch. Where was that? We talked about, yeah. Okay. Yeah, Farfetch was at its peak, it was valued at $70 billion. That's what the zero ZERP does to you. And then in the December and near end of December, Coupang acquired it for $500 million because, I mean, Farfetch never made any money. It was just like interest free. And we have seen many how those startups have done anyway. So the reason Farfetch was, they acquired Farfetch because Farfetch is, go back, look into Farfetch. It's an online retailer of luxury goods. And that gives basically brings all those customers who want to deal in luxury goods under Coupang, and Coupang can use its network to do stuff which Farfetch couldn't do, right? Coupang has been spending billions of dollars over the last 10, 12 years to build a fulfillment network, right? It's an e-commerce company. You can't just download the stuff. You have to build the delivery network, which Amazon spent years and hundreds of billions of dollars building it. Coupang is also doing the same stuff. So anyway, so revenue was up 23% to $7.1 billion. Gross profit up 36%, right? Now this revenue also includes the Farfetch revenue. So what I didn't like, well, I mean, things negative were operating income was down, net income was down. So let's see what happened here. Operating cash flow was down. Net income, Farfetch is a big losing business, money losing business. If they had not included the Farfetch into their P&L statement, it would have made gain of $98 million. So right now they have completed the acquisition. So all the Farfetch numbers also show up in their balance sheet. And from this quarter, this whole big operating income is down so far because they had to take a restructuring charge. By the acquisition of Farfetch, they fired a lot of people. They're restructuring the company. So you have to take that one-time restructure, not one time, but I think the restructuring charge, management only talked about it in Q4, and that's what they did in Q1. And that's why we see the income is down. Let's look at the business side of the house, right? Active customers up 14%. Adjusted EBITDA doesn't include your SBC, etc. 281. Product commerce revenue is up 15%. Developing offerings. So product commerce is their main e-commerce. Developing offerings are the Coupang Eats, the smaller and a growing business, Coupang Eats, Coupang Play, and the other Coupang Pay, the Coupang gaming stuff. Those are smaller, growing businesses. And it's a business in Taiwan. So they're also moving from South Korea into Taiwan. I mean, when I look at the business side, things look okay, right? Even though the net income is down by whatever percent, overall business still look fine. So I took that opportunity, stock was a little bit punished. So I thought I'll buy it. Impact of Farfetch, revenue would have been up 18%. If we, exclude Farfetch, net income would have been up by $98 million. Excluding Farfetch, the developing offering growth was 134%. And EBITDA would have been negative 155 million. What I did not like, and this is what I hate when companies start to change the metric on which they report, from Q1 2024 onwards, we will not report active customers. Rather, we'll report active customers for product commerce segment only. So that's why I don't, from going onwards, we'll only see for product customer. I don't know why. Why not for the developing offerings? Guidance. In addition to Farfetch, we are now guiding that the developing offering will be 750 million, increase of 100 million. And this is very important. Farfetch, they're pushing Farfetch company to achieve positive adjusted EBITDA by end of 2024. The company that have been like bleeding money for 3 years, and now within a year of acquisition, at least Coupang is making sure that on a run rate basis, they are at least have a positive adjusted EBITDA. So basically focused on turning around Farfetch so that it starts contributing in a positive sense to the overall margin profile of the business. Looking at a capital allocation, of course, I don't expect them to pay dividend. Little surprised to see that they bought back stock, but they bought it back from some early stage investors. So this is not a regular stock buyback. What else? I guess that's it. FLC, which is like a fulfilled by Amazon, it is equivalent of fulfilled by Amazon, in which the third-party sellers just use Coupang FLC. There have been some accounting changes that have happened, but nothing that is worrisome. They are going to continue to invest in infrastructure and giving more and more wow benefits to their customers. There were questions asked about the Chinese competition. Right, so this is what they had to say. Bob Kim has to say, we've always had many competitors, constant stream of new entrants, and the Chinese e-commerce players are the latest to enter the market. Right. Again, I want to note that we still have just single-digit share of the 560 billion commerce opportunity in Korea. So a lot of a room for them to grow despite the competition. Other thing you need to pay attention to, advertising is growing faster than the rest of business. Remember Amazon story? Advertising now is becoming big enough for the Wall Street to actually take note of. Same story being played out here. Okay. Then he talks about 5 takeaways. I'll skip that. Punchline for me of all the takeaways and from earnings call was, we'll continue to be disciplined with our investments. I like when the management is disciplined. Our goal and objective is to maximize long-term free cash flow for our shareholders. Goal is not to become the biggest player. Goal is not to have the highest revenue growth. Goal is not to maximize my market share. Goal is to maximize the long-term free cash flow for shareholders. This is a different CEO. And I love its focus on shareholder value than trying to increase its empire by acquiring other companies or trying to gain market share, right? You gain market share and don't return value for me is not a workable strategy. Anyway, trends I don't think are comparable. Stock was down 5.5% because they didn't like the net profits came down. So when I looked at it, I'm like, I don't think there's anything to worry about. So that is why I bought CPNG. When I showed you it's opportunistic buy, market gives you those opportunities. Coupang, my conclusion is still in the investment phase. He emphasized multiple times that a long runway is there, so need to continue to invest. So if you want to be a shareholder, you need to have a really, really long-term outlook. It's not gonna give you return in a year, 2 or 5 year. They are very much in investment phase. And thesis has not changed after the quarterly results. So I'll continue to reduce cost basis and buy more at a lower cost. That's on Coupang. We didn't see, I think last week or 2 weeks before, someone asked me, what do you think the impact of this fee increase would be, which they did? Haven't seen any decline yet, but we'll see. If users don't like the increase in fee and then they move over to competitors or not. But so far, whatever I saw, I like Coupang. Any questions? So that was Coupang. We're done with Coupang. Next one, Uber. Okay, let's go to Uber. I'll be going quickly unless you have questions because, hey, we have to cover a lot of ground, man. Or I can just give you a summary and be done with it. Whichever way you want to go with. And thanks to you all that I actually had to, I was like forced to do them. No, I want to talk about it and I better have all the content ready. I was a little becoming lazy this week, but had it not been for this week, today's meeting, I could have skipped some of them. So that's why I'm like, thank you. I also learn along with you. Okay, let's talk about Uber. Revenue of 15%, $10 billion, gross profit up 11%. Everything looks good. Net income was down 317%, right? So they beat on their bookings, beat on their guidance, but the net income had dropped. What happened? What gives? Almost more than $500 million in losses in net income. So when you dig deeper over there, then you find that it doesn't reflect on management or operations of the Uber company. And that's the reason for some of the companies, I would just not look at a net income. It's immaterial to me. Uber is one company where looking at net income is useless. I would rather look at operating income than net income to see how Dara, who's CEO, how is he performing or how is his team performing. And when I look at operating income, and as you can see, operating income is like up 166% year over year, right? Operating income is up 166% year over year, 28% 3-year CAGR, right? Pretty good. Net income is down 654 million, is down like 317%. So I'm like, okay, what's going on here? This is something which is related not to Uber, but their investments that they have in other companies. It could be Joby Aviation, or could be, I think, Aurora. I mean, Uber also has invested in other companies which are working on either autonomous driving or on what do you call, like drone delivery kind of stuff, right? And depending on what's happening to the share price of those companies, Uber has to report the unrealized income or losses on its P&L statement that impacts its net income. So if any company, even for Berkshire Hathaway, if you're looking at a Berkshire Hathaway, don't look at net income on Berkshire Hathaway, look at operating income. Because net income will be impacted by what happened to Apple stock. That has got nothing to do how they're operating Berkshire Hathaway as a business, right? So same is the case in Uber. So when I look at it, I'm like, they got a strong balance sheet. They got almost $8.7 billion. They got a free cash flow is growing nicely. 60% 3-year CAGR free cash flow on a quarter-to-quarter basis. Like this is the company which was earlier told never gonna make money, not gonna survive. Not only they turned around the business, and that's why I think I also tweeted, I have a kind of a man crush on the CEO, Dara. I just love listening to him, right? He turned around the company and they're enjoying like nice free cash flow. Net income is impacted by the investment. So even forget net income, operating income has been positive for last 4 quarters straight. Right? So share outstanding grew only at 3% and 3% CAGR, right? This is much better. At the start of, when Uber was younger company, they were diluting a lot more. They were giving a lot more stock-based compensation to their employees and diluting a lot more me as a shareholder. 3%, I can live with it, right? Ideally, I would want it to be 1 or 2%, but Uber is not mature company yet, right? So 3% is fine. Unlike some companies which are doing like 20% stuff. So you see the margin profile has changed. Operating margin from negative 50% some quarters, now they're like last 4 quarters all positive. Net income you can ignore because that's cash equivalents all fine. Share-based compensation has subsided. So I think I'm fine with it. Business side, trips increase, gross booking is up, mobility revenue is up, delivery revenue is up. Freight, they are seeing some weakness on freight side of the house. But other than that, I think your monthly active platform customers, they're also up 15%. So what I like most about is number of customers are up and the number of trips that each customer make is up, which is called the frequency. So which is basically increasing the overall gross booking value. It is not, I'm not going to go through all the, okay, where's my other, yeah, okay. So we'll skip some of the finer details. We'll go through only the positive and negative points. So instead of increasing the prices, the growth that they're getting is that the customers are taking more trips and the number of customers have increased. So positive points, 21% increase in number of our trips, as we can see, to $2.5 billion, expanded its audience by 15%, 249 million. They have a 7.1 million drivers, 4.2 billion of free cash flow. We already looked at. Strong demand for Uber service continues, and the expectation is 20% year-over-year growth on constant currency basis. Right? Forget about the forex impact because that's not something that they can control, but 20% year-over-year growth, which is pretty nice. Negative, or I would say something that they should be watch out for is how about the potential impact from AV? Like Tesla robotaxi, is that going to kill Uber? That's a big question that investors have on their mind. Is Tesla going to kill them? Forex headwinds. So if you invest in any of the LATAM companies, you know what's happening in Argentina. Mercado Libre talked about FX headwinds in Argentina. Uber talked about the fact that just impact to Argentina pesos is around 5 percentage points on the gross booking growth. 5% came from the forex impact. Investments that were held back in Q1 due to lower ROI expectation, those gonna reinvest it in Q2. What else? Yeah, delivery, grocery, and delivery retail segment, they are not yet profitable. Margins are improving, and I think some challenges in Seattle and New York, regulatory challenges. I think Seattle, they're gonna talk to the city council because it looks like it has backfired. The regulation has backfired. There are more and more drivers. They are now, instead of getting more money, they're actually driving less for Uber and hence not making that amount of the money that they were making. So it looks like there is a proposal to undo what it was done. So anyway, guidance was 38.75 to which is like 18 to 23% growth year over year. And adjusted EBITDA was this. Share repurchases, this have started to repurchase the share, which I like it because, come on, what are you going to do? You got a $4 billion in cash. And if you can't deploy it into, effectively, give it something back to me. So they have started to now buy back some of the shares. I'll skip all these big details. What else? Uber One, which is their membership. Now it's the fee that they're generating is now more than $1 billion. And advertising, again, it's almost hit 900 million run rate. It's almost $1 billion. So, and I had surprised, I saw ad when I tried to hail Uber. I'm like, that's cool. Now it's started to show these ads. Stock reaction, stock was down 10%. Why? Of course, to 500 bips hit due to Argentina peso. We expect mobility EBITDA margins to be low quarter by quarter. That's what management said. Market was expecting Uber to generate $400 million of net income, and it came with $600+ million of losses. Stock doesn't like, the market doesn't like these things. Right? So stock was punished. It was down like 10%. From my side, I'll still want to hold it. I think business is still doing fine. Look at the operating KPIs in the business. It's all good. There's a threat for Tesla robo taxis. We'll see it. Uber is anyway partnering with AV, and their idea was, and there is if you get into the details of the transcript, you'll see specific questions around how you want to tackle. They say, you getting a AV tech doesn't make you, won't make you the best kind of marketplace to match the drivers and the riders. And number two, so Uber, you could, whether you use AV or whether you use a driver, you can always come on board onto Uber platform. And if you use AV, you're going to make more money. Right? So we are a platform. We will welcome even the AV owners. Right? So I'm not much concerned about it. I will be willing to add more below 70. So I have a short put at 70. Future outlook with Tesla FSD by 8 is a big threat. It's impossible, never know. Yeah, this was talked about it. We'll see when it happens. But if you are a Tesla owner, would you could sign up on Uber and then have Uber manage all the logistics and reduce your freely waiting time, and use your Tesla to the maximum, because they have that tech. No other company has built up that tech over the years. I would rather put it on Uber platform than putting it on Lyft. Anyway, so that was Uber. They also have signed up with Instacart to do food delivery. Again, if I'm a driver, and for me, any minute when I'm not driving is a lost opportunity for revenue generation. So Uber is trying to do all the things that they can do to make sure that once the driver is on road, they have all the work available and very, the minimum waiting amount of a time. And that need a lot of machine learning AI to figure out where to sell what driver to. Is there a grocery pickup on the way? Is there a restaurant pickup on the way? Is there something else that the driver can do while he's waiting, for his next ride, etc.? That's the tough problem to solve. And if Uber can solve that, and no one else, then why would I not put my car robotaxi on Uber so that it doesn't wait and it can get me the maximum revenue? So anyway, so that's Uber. Any other questions on Uber? Let's move on to the next A, B, and B. And then one more will be Palantir, and then we'll be done. A, B, and B. Oops. Come on. There we go. Beat on revenue, gross profit up nicely. You can read through these numbers, so I'm not going to read every number anyway. There was a beat on revenue. So basically the beat on top line, which is revenue, as well as bottom line. EPS was up 128%. Free cash flow, $1.9 billion, which is the highest ever for any quarter in the history of the company. Past 4-quarter free cash flow, almost $4 billion. Uber had $4.2 billion, Airbnb has $4 billion, which is almost 41% free cash flow margin. Like, come to think of it, it's like a hugely free cash flow generating business. So I looked at a stock-based compensation. Is the free cash flow all coming from stock-based compensation? No. So 1.18 billion coming from stock-based compensation. So that still leaves almost 2.8 billion of a free cash flow, which is still good for a company like Airbnb, which is still, growing company. $11 billion in cash, so strong balance sheet. Plus, they have another almost $9 billion, which is held on behalf of guests, right? So these are the stuff which, let's say, if I book on Airbnb, I paid, but I haven't yet gone and utilized it because I haven't stayed it here, so I can cancel anytime. So that's almost $9 billion. Talk about float. And somehow maybe we should go and give an idea to Brian Chesky. Hey, you got a float available? Let's put it to some use. I'm sure they're probably putting it in the treasuries. Well, let's give him some ideas, man. Give him some stocks to buy. Anyway, so from a cash position, I think pretty strong. Business-wise, gross booking value was up 12%. Nights and experiences 9%. Average daily rates increased, even though the active listing were up 15%. And I hate that they're not giving me the number, but they only said that it's up 15% year over year. So you got a more supply, and then you're still able to charge more than what on an average rate was last year, which is great. More supply has not reduced the average rates for the rooms. Right? The brand continues to make traction with the travelers. So to me, everything looked good for the quarter. Right? So nothing to complain about. Guidance. They gave the guidance of growth between 8 to 10%. Right? Remember, they grew 18% in Q1. Now you're guiding that you're going to grow 8 to 10%. We expect EBITDA to be flat on nominal basis, but down on EBITDA margin basis. So revenue growth slower than what you grew in Q1. Margin will be lower. Market doesn't like slower and lower. Okay. So maybe I should put that stock reaction right up front. Because always when you talk, nowadays, most of the time the stock is just being changed. So first Q is generally weak for any travel company. Now Airbnb is saying that even on a Q2, you're going to have a little slower growth and decrease in margins. Stock was punished. It is down like 8% after earnings. Capital allocation, 750 million stock buybacks, which I like. Plus they got another 6 billion. I'll skip all that. New thing, they introduced icons. So icons is where some celebrities, basically you get to stay in the same kind of a same house as that of celebrities. So this was like this house like in Up movie, then live like Bollywood star, train at the X mansion, game with a Kabi Lame. So that's seeing some traction. This is the newest product that they have done. I mean, they've done over the last few years, almost 500 new enhancements to their overall app. So market didn't like the guidance. My management says that Q3, they'll be able to pick up the slack. So hey, it's a question of Q2, wherein we might see some slowness. Currently, share price of $147. Assume that 8.5% of free cash flow growth per year for the next 10 years. Right? So then I look at, okay, let's look at the other valuation, other metrics. Right? Can they grow their free cash flow higher than 8.5%? Looking at the last, whenever it became public, the median growth is around 20%. So to me, it looks like 8.5% should be doable. Other, if I look at PE is 19.6, which is cheaper than SPY. Forward PE is expensive, but look at a PEG ratio, 0.82 is even less than 1. So yeah, it is the price to earnings is expensive, but it is also growing faster. That's why it is expensive. 70% gross margin, 16% operating margin. Sales is growing at 28% past 5 years. So I don't think that the valuation is stretched at $147. So it's our opportunity to refill the tank and sell a premium. And that's the reason why I bought Airbnb this week. Market gave us opportunity. Stock was down, whatever, 8%, 10%. I'm like, okay, I can refill some of my tank because some shares were called away in 2023. When I had a covered call, I had to sell some. Okay, let's add it back. So that's where market gives the opportunity. If you have an outlook beyond just 1 quarter. All right. If no questions, then last one, and then we'll be done with this. Let's talk about Palantir. Similarly, I'm going to rush through this. Revenue up, gross profit up, margins up, operating income up. There's nothing. I think operating cash flow was down because of investments that they talked about. So let's look at the good stuff. On the financial metrics, as you can see here, what I like good about them, revenues up 21% year over year. Gross margin is still above 80% as a software company. 6 quarters of GAAP net positive income. So this is again, like company used to lose tons of money, but now they got a 6 continuous quarters of positive net income. Again, I understand net income and operating income are 2 different things. So we should focus on, but yeah, Street want to see how you're doing in terms of a net income perspective, right? So lots of traction in the US and commercial, US commercial and government. So on the US side, they're doing much better than on the international side in this quarter, right? So billings is 625 million, which could get converted to revenue. So it's an indication of future revenue. Customer count is up 42%, right? All good. Not so good. I still hate, and I talked about it in previous quarter also, that operating margins are so low. This is one bearish thesis I have. And number 2 is $193 million they spend on sales and marketing. And whereas if you listen to the CEO, Alex Karp, he says, we don't even have a sales and marketing. We don't even know how to sell. Dude, why are you giving 30% of revenue on that? So either I can't reconcile both the stuff, right? So that's my like a bearish thesis is your operating margin sucks means either your product, you're still developing the product. So you're still investing a lot in product development and your product is not mature, which belies the fact that how you are then signing up so many customers. Or your product is very complex to implement and is you have to use a lot of consulting hours, a lot of people hours, then the model is not scalable, right? So I hate that operating margin is this. Return on investing capital is still bad. It's negative lower. And share dilution, it is like 10%, right? Which is what I hate. Like I said, 3% I liked on Uber, but 10% Palantir, it is much better than what it used to be. But yeah, this is the reason why I can't increase my position that I hold in Palantir. I want to see better operating margin. Otherwise, it's more of a consulting business and not really a software SaaS business. Capital allocation, 9 million buyback. Then they talked about bootcamp. 915 companies have participated, and bootcamp is like their quick way to showcase the strength of the product and use customers' use case to implement the use case in 2 or 3 days, and sometimes in a few hours. Yeah. And on the rule of 40, CEO will come and talk about rule of 40 and then say, right now they are 57%. I don't even know why he talks about it. I think just a distraction. I've seen rule of 40 being applied to new growth companies, but Palantir is not a startup company anymore. So I think that's still just a distraction. This is what he has to say about competition. I don't believe we have a competition in US commercial and US government space. To me, it sounds like more being cocky. And whether it's investing or business, you should not be cocky, right? You never know who is the next person building your competitor in garage. So stock was down 8%. My conclusion was because the guidance was lighter than what the street was expecting. And my conclusion was operating margin is still low. I think I already talked about it. I'm holding it and I'm selling Strangle to reduce the cost basis. I want to see some better margins before I go big on Palantir. This is a stock loved a lot by retail investors on Twitter. So you will see a lot of FinTwit, pumping this stock, if I can use the word pumping, but you got to do your own due diligence. And mine is, guys, I want to see better margins. So position size it accordingly. With that, I'm done with all the 4 earnings, like quick fire earnings. One beginner question. Chandra say on Palantir, Strangle, sell. One example, please. I think, okay, I can't pull up Think or Swim, but let me just go to, hold on, let me just show it to you. So the guidance is on Yahoo Finance as well as guidance also on, I mean, you look into their earnings press release or earnings report, they will mention it there. They have to. I mean, if they're giving guidance, then they have to mention it in their earnings release. Some companies don't give guidance. Like Apple doesn't give any straight guidance. So hold on, let me just show you Palantir. So Palantir, I think I do have a fully, come on. This Google shit, I don't think I have never. Okay, let's go to P. These are my open trades, option trades that I have. Palantir. So this is gonna expire worthless. You can see my screen. Screen visible? Okay,
Yes.
cool. So let's go to Palantir. So 26 call on 17th May, this expired worthless. So then I had 5-7, I sold a put because stock was down 15% after earnings. And that's it, my comment. I mean, this helps me because I take a notes. Earnings was not that bad. Had closed a May strangle. So I opened a short put, then adding another one short put at 22. Then I added a call. So this is against 20th short put. I added 23 calls. So I got a 20. So strangle is you have sold a put and you sold a call. So this is what then your P&L is like this. So if it goes below 20, I will buy it at 20. And then 23 cover call expire worthless. If it goes above 23, then I'll have opportunity to sell it at higher than 23. And if it stays between 20 and 23, I just collect the premium and reduce my cost basis. So that is one example. I still have 122 put, which is I probably will convert to strangle. Let me say, let market go a little bit higher, then I may convert it to strangle. Cool. Alrighty. Anything else? 2023 not, but it's a $20 stock, man. So $3 is like what? 15% move up or down. So you always look at from a delta perspective. So 23, when I did it, it was at 30 delta. And because I own long stock position, I'm okay to do a sell a call near 30 delta. Like it's the one contract, right? It can get called away. I have like a lot of other shares which will benefit. So I'm fine with that. It's a 30 delta call. Again, we have not covered the concept of delta in bootcamp. So my apologies if that's not familiar term, but as an option seller, you need to know what the deltas are to decide your strike price and all that. Okay. Oh, then it's good. Has anyone converted TDA and logged in already? I did not. I'm a little scared. So has the conversion finished? Okay, let me see. Okay, guys, we're done for today. Let me try to see if I can log in into Think or Swim. Let's stop the recording and stop sharing.
I don't think it's the same